Hey guys, my name's Jeff. Welcome to the channel. If you've been here before, then welcome back. Today I want to talk with you about Alphabet stock. I have never invested in this stock before, but I'm planning on it. So as I make this video, I do not own any shares of Alphabet stock, but by the time you view this, I will probably be the owner of several shares of Alphabet. So I want to talk with you about why I decided to buy this stock. And I want to share with you my way of thinking about it, okay? This is part of your investing education. I want to tell you right off the bat that what I share with you is not the common way that everybody thinks about buying stock. And I want to show you a visual. You see this? This is a fence, little fence. And this fence represents the fence that I put around me and my way of thinking about investing. If you watch CNBC, financial media, a lot of other YouTubers will put out videos about what the price is now and what they want to get in at, and they're already thinking about, when to sell, or they're buying puts or calls on stocks. Well, I'm about buying stock in quality companies and holding it for the long term. So when I'm talking about Google here, Alphabet, I'm talking about buying share in a stock that I think makes sense for me for the long term, because I don't want to have to think a lot, every week or every month about whether I made the right decision. And I also don't want to go into buying a stock already thinking about selling the stock. This is trading, it's jumping in and out of the markets, and it's not my scene. So anyways, this is the fence around me. I think differently. I encourage you to think independently. When you buy stock in a company, you're actually becoming a part owner of that company. So when they make money, when they make profit, hopefully they'll make some profits, a part of that is yours. Now, the company sometimes will keep that profit within the company, but you still own, you're legally an owner of a slice, a very small slice of that company. Or they may return some of the profit to you in the form of a dividend. So any of you who may invest in stocks that pay dividends, that is you getting your fair share of the earnings or the profits of that company. So that's the first thing, you're an owner. The second thing, you should take advantage of fluctuations in the market, in the stock market. Sometimes the market gets very excited and happy and the stock prices go high. But then sometimes people get real pessimistic in markets. Investors get very scared, very nervous, and they sell. And your job is to not feel you have to learn anything from the market. It's not there to instruct you or teach you, but just take advantage of the prices when they make sense to you. These concepts are covered in Benjamin Graham's book, The Intelligent Investor, but the three most important concepts are the first one I mentioned, which is buying stock is owning a piece of a company. The second, take advantage of Mr. Market. Sometimes he's up, sometimes he's down, but you just take advantage of those prices without getting pulled into it emotionally. And the third thing is you want to buy things where there's a margin of safety. You want to buy stock when it's cheap compared to the value that you get in that company when you become an owner. So that's what I want to share with you, a few thoughts about this. And I'm going to break it down for you and keep it simple. First of all, GOOG is one of the ticker symbols for Alphabet stock. They also have GOOGL. You can read online about the differences between the two, but I don't want to get too deep into that. I will probably buy just GOOG. So that's Alphabet stock. Now what I wanted to share with you is I watched a YouTube video just the other day, and it was by a YouTuber who was very excited about buying this stock. And he did not, however, talk a lot about the company itself. He didn't focus on the underlying company. He was more focused on the chart. And he noted that there was an announcement that Google was about to split its stock. We'll split the stock. I'm not even sure of the date. But his view was that looking at stock charts for other companies, it seems that the stock price goes up in the time leading up to the stock split. So he had decided, and the video was actually uploaded on February 2nd, 2022, he had decided that he wanted to buy the stock because of this past performance in the charts of other companies. And at the time he made his video, on the screen when he was showing you, he had, I guess, just bought stock. The share price was $2,970.91. That's right there. I think you can see that. So that stock price is somewhere in the range of what he paid. And one other thing I should note, his video was February 2nd. Google had released its earnings for the fourth quarter of 2021. So it had just released its quarterly earnings. They were very strong. The company had earned $75 billion in profits that quarter and had had a phenomenal 2021. So he was buying at this moment when there was a lot of enthusiasm for Google stock. And I also wanted to just note, on that particular day he made the video, the high stock price for Alphabet or Google was $3,142. And one thing that's worth noticing is, and I've looked at the historical prices for this stock, that was the all-time high, at least I think all year in 2022, but probably the all-time high ever. So keep in mind that YouTube people are not immune from getting swept up in excitement and in the euphoria around a stock. And so again, the market and the prices and the euphoria don't teach you anything. So you need to keep your mindset kind of calm and clear and pay attention to information about the company itself. And I view, thinking back to that fence, that it makes more sense to look at the company's financial situation than looking at the stock chart and predicting that the price on the chart will go up because the company's about to have a split, for example. So here are a couple numbers that I think make a lot of sense when looking at Google. The earnings per share, okay, in 2020, for each share that you own of Google, the company earned $58.61, okay? So what this means is that the company was profitable and that the company returned that much to shareholders. Now, 1 year later in 2021, the earnings per share were $112.20. So what you can see there is that the earnings per share doubled, okay? And I think this is worth noting because this is a phenomenal increase. For a company to increase its earnings by 10% or 12% or even 15% is really phenomenal, especially with a larger company. Once a company becomes really large, it's hard to increase by large numbers. You get so big that usually you just make incremental changes. But here's Google worth, $2 trillion, and they're able to increase their earnings. They're able to double them. So the company, in my view, has been doing really well. I am willing to forgive whatever its future quarters are going to be because I understand the country and the whole world is going through a real difficult time now with potential for recession, with interest rates rising, and with the stock market crashing. So there's all kinds of possible outcomes in the next few quarters, but they don't interest me because I'm not focused on the next quarter. And I think for any investor, including you, you just need to decide, are you in the circle of the long-term investor who is buying a part of a company? Because if you are, it shouldn't matter what happens in the next few months or even in the next year. So anyways, there you have the earnings per share, which I think do matter. And then I think it's worth noting that Alphabet is either number 1 or number 2 in online search. So when somebody searches for something, when they want to learn about something or search for information, the number 1 place they go is Google, and the number 2 place they go is YouTube, which is owned by Google. So I think in that respect, it makes a lot of sense to be an owner in a company that controls the internet, that controls internet search, I should say. And they don't control it, but they're just the dominant player, and it's by a long shot. It's not by a small margin. So then what else could I say? Well, as of Friday, so this is made over the weekend, but on Friday the 17th, the Google share price for GOOG, the Alphabet, I should say, stock price for the shares in GOOG were $2,157.31. That's the closing price. So you can see a couple things. First of all, this is a lot lower than what the YouTuber who made the video right after Google's phenomenal earnings paid $2,970 or so. So I think that this price here gives you a great margin of safety. And this is, again, something that Benjamin Graham talked about in The Intelligent Investor. He said, you know, sometimes your math might be off by a little, you might have worse than average luck, all kinds of things can happen. So you don't want to make the price you pay too close to your valuation of what the company's really worth. And by the way, I should say, I think that the price paid back in February was probably a fair price. It might have even been a slightly lower price than the fair value of Google, but if you want to compare 2,970, 2,157 is much cheaper. So I believe this is clearly a substantial margin of safety compared to just 4 months ago. And these are the kinds of things that long-term investors want to look for. You want to look for a situation where you can buy into a company and it's so cheap, it's just screaming out at you that this is a bargain. And you have to decide whether you're willing to take that risk. Now, here's something just to keep in mind. I'm decided to buy this stock and hoping that I can get it somewhere in the range of where it was Friday, that 2,157 range. What I think you have to keep in mind, or what I'm keeping in mind, is, you know, the price could go down another 5%, it could go down 10%, it could go down 15%. You never know. When you commit to buying stock, you're taking a risk, and that's why investing in stocks is not as safe as, say, putting your money in a savings account. When you buy stocks, there is a chance that you could lose a little or a lot of money. That's just part of the risk that you take. But I would rather buy something that I think is already at a significant discount. Could it still get cheaper? Definitely. And I think from here, the amount of downside risk is less than the potential for this company and this stock to rise over the next several years. So for me, the risk is very low compared to the potential reward over the next 3 or 5 or 10 years. So let me just show you a little bit about how I consider or think about what the discount is. All right, I've already showed you everything here, except I haven't pointed out that in my estimation, the fair value of this company's stock is about $3,600 a share. So what I like to do is take a look at Alphabet's fair value and then look at the closing stock price on Friday and compare the two and see whether the stock price, what it's selling at most recently, what that is in relation to the fair value. Alphabet, ticker symbol GOOG. The June 17th close price was $2,157.31. And my estimate of the fair value is $3,600. So you can already see that this price is a lot lower than my estimate of the fair value of Google stock, okay? So to find out what it is, we want to solve what's the percent that this is of that. So x over 100, we're solving for x, equals 2157. We'll just round that over 3600 equals, all right, we get 215700 divided by 3,600. 3,600 times 6 would be 180, would be 21,600, so it would be 216,000. So The current share price is about 60% of the fair value. Put another way, the stock is at a 40% discount. Can you see that? The risk you take as an investor is that at any particular moment, you could be wrong, and the stock market has a way of making people look silly. And just one thing that I've learned is if you're able to extend your time horizon as an investor, then it's a lot easier to make these decisions because you're not worried about, well, if I buy it now and the stock price goes down 10% next month, what am I gonna do? Because going into this investment, I've decided that if the stock price goes down 10 or 20%, I'm just gonna sit tight. I do think that Alphabet stock represents a much greater discount now at 2,157 than it did 4 months ago at 2,900 plus. It's a lot cheaper. And so for me, that means it's a lot less risky than it would have been even a few months ago. I hope that this info has been useful. I'm real interested to know, what you think about Alphabet stock. Are you an investor? Are you thinking about it? Please put any comments in the comment section below and I will check them out. Like the video and subscribe if you would like to see more videos like this in the future. I'm real glad you stopped by and I look forward to seeing you in the next video.